think money takes up more life space than it should? On this show, we discuss with and share stories from artists, authors, entrepreneurs, and advisors about how they mindfully minimize the time and energy spent thinking about money. Join your host, Jonathan Dio, and learn how to put money in its place and get more out of life.
Hey there, welcome back to Mindful Money. We're in the second to last stages of describing the Mindful Money modular financial planning process. Last time we talked about what we do with excess income after we have a fully funded emergency fund, have paid off all of our high interest debts, and are saving enough to be on the path to financial independence. What that means is we talked about the big choice, whether when you have excess income, you use that excess to pay down or pay off low interest debt, or you use it to start to build your taxable savings. If you haven't listened to the episode, then definitely go back and listen. And just so you know, I fall on the side of if you have that choice, pay off low interest debt or build taxable portfolio, you build taxable portfolio. Today, we're going to talk about how to invest all of your portfolios, retirement portfolios and the taxable portfolios. So this episode is the 9th in our 10-part series, which covers everything you need to know to get started creating your own modular financial plan. I want to start with a story. So after he'd been a client for about 6 or 7 years, Mark approached me at an event and he said, Jonathan, I've listened to these January forecasts and this July halftime report for about 5-6 years, and I finally understand what you do. We hired you to manage our investments, but I finally concluded that you don't really manage investments. You're doing something far more important. You're managing us. You helped us build a portfolio of appropriate investments perfectly suited to our life plans, and the next day, all you've done from that day to this day is prevent us from overmanaging them ourselves. We revisit the plan regularly, but the prevention requires constant attention and communication. This Mark is 100% right here. This is accurate. Great advisors, in my opinion, do 2 things. First, they help people codify a lifetime of trade-offs in a well-researched and deeply considered financial plan that looks at all of their resources and all of their values. And second, they help people stay on the plan when it's hard to do so, especially. So during my first 10 years in the industry, I personally tried every imaginable way to invest. In the end, I determined that I can't predict or control the short-term outcomes of investments, period, full stop. I don't take any shame in this because what I know is no one else can do it either. My approach to investing my own money and my clients' money comes out of this experience and has been verified by reams of academic evidence and is modeled after a long list of humble advisors I've known over the years. So great fiduciary advice is a progression, right? We help clients first express their values in terms of prioritized, time-specific goals. Second, create dollar-specific plans to reach those goals, inflation adjusted. Third, we build a savings and portfolio process with the highest probability of bringing those goals to fruition in the time allotted. And fourth, we filter the noise from the punditry and their own thoughts to avoid rash decisions forever going forward. And of course, we revisit some of the decisions and revisit some of the priorities over time. So numbers 1, 2, and 4 are the most difficult and time-consuming. Number 3 gets all the attention. Once you get the goals, the first step, and the plans, the second step, right, the portfolio, the third step, is easy. Once you have the portfolio in place, it doesn't change unless the goals and the plans change. It's not just that we don't change the portfolio in response to changing market or changing economic scenarios. It's that we meet with wisdom and compassion our clients' near constant desire to tweak and optimize things that cannot be tweaked or optimized. We don't manage investments, we manage people. However, in our market-focused and performance-driven culture, many advisors and many clients still believe that the expertise that an advisor provides has something to do with prediction, better market timing and or improved security selection. Mindful Money and all of my work with clients through EP Wealth is a no prediction zone. There is no escaping 4 fundamental investing truths. First, economies and markets are inherently unpredictable in the short term. We cannot know what is coming next. Second, the unpredictability of markets and economies never stops people from trying to predict. Third, some of those who try to predict are going to get it right. I mean, if tens of thousands of people or thousands of people are trying to predict, a few of them are going to get it right. And when they get it right, they're going to scream it from the rooftops. And finally, and this is important, because out of the thousands or tens of thousands of people who try to predict, the few of them get it right, those who get it right aren't skillful. They're lucky. In the short term, it's all speculation. It's all a crapshoot. An individual investment for a short period of time can be tossed about by all manner of unexpected occurrences. There is no predictability, full stop. We cannot manage risk or return in the short term, so we let it go. All successful long-term investors are continuously acting on a plan that is founded on their deeply personal values and goals. They're appropriately allocated, they are broadly diversified, and they rebalance regularly. They are patient and remain mindful of their limitations. All failed investors are continually reacting to yesterday's headlines, and every reaction is a form of prediction. Nobody knows what's coming next. No one knows how markets are going to react. We can't build successful portfolios on the unknowable. Stop predicting. So what is simple, basic, mindful investing? What are the actions that we embrace? Now, I've always referred to myself and my basic style of financial advice as being goal-focused and planning-driven. The portfolio is always long-term, and the portfolio design comes after and is informed by goals and planning. The beauty of this is that I'm focused on levers that can be pulled to improve client outcomes. Meanwhile, the financial world, especially anything calling itself financial media, is short-term, market-focused, and performance-driven. It puts the portfolio discussion before goals and planning. They are pulling levers that study after study after study have shown to be ineffective at improving investment outcomes. Our simple, basic, mindful investing process is countercultural. If you embrace these three core practices, you don't need to do anything else with your portfolio. They are necessary and sufficient to providing excellent, real-life, long-term investing outcomes. The core practices are these. First, asset allocation. Second, diversification. Third, rebalancing. That's it. Get these three right, and you're 95% of the way there. The first one is asset allocation. Asset allocation is the strategy of dividing your investments into a mix of different asset classes with the aim of appropriately balancing risk and reward and increasing the probability of reaching your goals. So there are only three primary asset classes. There is equity. These are individual stocks, equity exchange-traded funds, ETFs, and equity mutual funds. I refer to this portion often as diversified shares in the great companies of the US and the world, great businesses of the US and the world. Second asset class is fixed income. This could be government bonds and corporate bonds, municipal bonds, and bond funds and bond ETFs. And the last is cash or cash equivalents, treasury bills, money market funds, bank CDs, and the like. So how you should allocate funds to these three asset classes is based on your individual needs, goals, and ability to tolerate volatility. Volatility is the unpredictable change in price. That means there is no right or optimal asset allocation. The key to choosing a successful asset allocation is to first recognize that each asset class acts in specific ways. Generally, the more stable and predictable an asset, the lower the expected returns. And that just kind of makes sense, right? The more volatile an asset, the higher the expected returns. Equity assets, like stocks, tend to pay the highest rate of return over time, but are also the most volatile. They zig and zag the most. Owing to this volatility and risk, however, stocks are a reliable source of growth in the long term. Fixed income assets, like bonds, are less volatile, and therefore they tend to pay lower returns. But they play an important role in the portfolio as a way to mitigate stock volatility or the zigs and zags of stocks. Cash doesn't pay much of a return, but it provides liquidity and also helps reduce volatility in your account. Since its face value is always stable, the stability makes it a vital part of the mix. It also is really helpful to have cash to sort of meet the short-term needs. So the long-term success of your investment portfolio depends more on asset allocation than the success of any particular investment in the account. How you allocate your assets may be the most important investment decision you make. So what percentage of your account should you commit to each asset class? The simple answer, it depends on your goals, specifically how much you need and when you need it for accomplishing those goals. Another crucial element is your ability to tolerate volatility. You want an asset allocation that you're willing to stick with over the long haul. This is an issue of commitment. We are committing to holding an asset allocation, especially when it's uncomfortable. And in a second, we'll talk about this. We're also committing to rebalancing that asset allocation, to buying more when it hurts. So I've written and spoken extensively about the importance of your equity allocation. This is your commitment to owning the diversified shares of the great companies of the US and the world. If you want more on this particular topic, again, return to this 10-part Versus the Gathering Darkness series, where I explain my absolute commitment to equities as the best possible long-term investment you can make. Ultimately, everyone must choose an asset allocation designed to generate the long-term returns they need to reach their own financial goals. The second item, diversification. There are no facts about the future. And what we think we know is often riddled with sort of tragic shortcuts in reasoning and unconscious biases. So instead of wasting time playing the guessing game of which investments are going to perform best, own it all. Diversification is the disciplined practice of choosing a variety of investments within each asset class. Diversification keeps you from foolishly putting all your eggs in the wrong basket. Diversification means you invest in the stocks of companies of a variety of sizes, industries, and geographies. You own big and small companies, growth and value companies. You own international and domestic. Personally, I seek out and recommend owning the broadest available index in each geography. I say own it all. And the same goes with fixed income. You buy an index that owns a representative piece of all parts of the fixed income market, from conservative and high yield, government and corporate, short-term and long, domestic and international. It is super tempting to try to put more money into investments that are performing well and avoid those that are doing poorly. But you don't know and can't guess what's going to do well next. You don't know what's going to become hot or become cold in the investment world. No one knows. By diversifying your portfolio, you will own some portion of the things that are doing well, and at the same time, you reduce the damage caused by any catastrophic failures. Diversification steadies your returns and reduces the probability of you experiencing either huge gains or huge losses. Diversification is the investing equivalent of choosing to be the tortoise in Aesop's fable. It's slow, it's steady, it wins the race. Once you're asset allocated and broadly diversified, the only thing that's left to do is manage it. And we don't manage it by picking and choosing. We manage it with rebalancing. We begin our investing journey with a plan-appropriate asset allocation. And over time, our portfolio goes out of balance as certain assets do well and others do less well. Regular rebalancing, the selling of the things that have done well and the repurposing of the proceeds into things that have done less well, returns your portfolio to its original plan-appropriate asset allocation. There's a tendency for both unnatural highs and unnatural lows in the markets to snap back to sort of a rising average trend line over time. This process is known as reversion to the mean, and it's entirely unpredictable. By rebalancing periodically, no matter what's happening in the markets, you create a system that buys low and sells high while always returning to your original risk-return trade-off. The system is immune to human foibles, to short-term fads, and to the investor fears or fantasies that drive irrational market swings. So by rebalancing at specific intervals, such as usually annually or semi-annually, you automate the buy low, sell high process without accidentally plunging into prediction territory. In the end, there is one downside to diligently practicing asset allocation, diversification, and rebalancing. You are never going to knock the investment ball out of the park, but you won't ever strike out either. Over the long haul, through all the zigs and zags and throughout the market cycles, you will end up faring better than most, and your path will be lower anxiety, paved by patience and understanding instead of the need to predict outcomes or guess what's around the next corner. Let go of the idea of finding the next Amazon or Apple. Let go of all your investment fears. Follow a simple, basic, mindful approach to investing. It is really that simple, but it's not going to be easy because we really, really, really want to react to headlines or excitement or expectations or fears. We want to do something, and this is something we need to learn to avoid. We know vividly what has already happened. We can never know what will come next. The humble recognition and remembrance of this truth should prevent us from reacting, but we will be tested. First, we're going to envy returns that we see other people having, but we are not experiencing. Sometimes a small fraction of the investable universe starts getting lots of investor and media attention. Often it's a new technology, 3D printing, electric vehicles, or AI. Or maybe there's a new investing product like a cryptocurrency, a SPAC, or an NFT. Or maybe there's a single company like NVIDIA that captures the collective imagination, and the growing attention attracts investors' dollars, and folks begin overpaying a little at first, and then eventually overpaying a lot for those investments. The more folks are willing to overpay, the better these companies and their investors, often our neighbors and perhaps our brother-in-law, appear to be doing based on stock price and returns alone. Our attention is then drawn to those returns that our brother-in-law or neighbor reports his portfolio is achieving, which our own broadly diversified portfolio is not achieving. It's so boring. And feelings of jealousy and missing out, FOMO, move us to sell the broadly diversified portfolio that isn't working as well as whatever's working for them currently, and buy whatever appears to be making our brother-in-law rich. In hindsight, we can see how well the strategy works. The internet stock boom led to the dot-com bust. CDOs, the things that led to the Great Recession, the collateral debt obligations, led to that Great Recession. Meme stocks exploded higher, and then they exploded. Multiple altcoins created millionaires before they went bust. Pandemic growth darlings everyone chased became post-pandemic canaries in the pandemic coal mine. So large upswings in specific investments usually lead to large collapses in the very same investments. If you're getting into them because they increased in value recently, you're trying to buy other people's profits, but you're likely overpaying. It's impossible to know how far, for how long such episodes are going to last before they fall apart. But we do know that they will fall apart. This is what is meant by reversion to the mean. So we do not buy out of envy. The second thing that's going to happen, and I hear this one probably more often these days, we fear impending doom. On the flip side, we may not be motivated by greed at all. We may be losing money or fear losing money and decide to sell our current portfolio to protect ourselves from this possibility. This, I hope you can see, doesn't work any better. Strangely, the financial punditry reacts to every 10% correction as the end of the world, and we broadly accept this reaction as truth, but it isn't. Such corrections are, as anyone with the slightest sense of market history knows, a common occurrence. The average annual peak to trough drawdown loss in the S&P 500 is about 14%. Whatever they're screaming about today may ultimately reach that mark, or it could be more or less. No matter how many people opine on the subject, nobody can know, and it can't be predicted. And of greater importance to long-term, goal-focused, planning-driven investors like us, it does not matter. You cannot predict your way around market declines. If you cannot ride out a market decline approaching 15% on an annual basis and declining, averaging twice that about twice in a decade, you simply should not be investing in equities. We might be afraid, but we do not sell out of fear. So before we wrap up today, I want to introduce 2 mindfulness practices to help you manage your own investing behavior. We can't eliminate the fear and envy from our lives. We can, however, be aware of their prevalence and attempt to not act on them. So when I'm caught in the moment and the fear or the envy rises within me, there's 2 practices I rely on to get me unstuck. There's a deep breathing exercise for quick relief and a longer body scan exercise for more challenging, those scenarios that kind of hang on quite a bit over time. Paying attention to your breath is most people's very first mindfulness exercise. It's simple, and it's always available because you're always breathing. In its most basic format, you sit comfortably, back kind of straight, and you attend to your breath. You pay attention to your breath. You might say quietly as you breathe in, when you breathe in and out. When you breathe out. The deep breathing exercise I would recommend has a little bit more structure to it, but only takes maybe 3 minutes. You aren't just paying attention to your breath, which can be hard for some people. You actually have something you are doing. You're counting. This 3-minute exercise will quiet most momentary emotions and repeating thought patterns that happen. Around elections, we're always worried about the outcome of the election. And so this is a repeating thought pattern. This breathing exercise might work. So take a deep in breath, 4 count. Hold it for a 4 count. Breathe out for a 4 count. Hold for a 4 count. And then breathe in. If you do this for 10 breaths, the rising emotion, the fear, or the envy will subside. The emotion will lessen its hold, and you will find yourself calmer. We call this box breathing. 4, 4, 4, 4. So that's one way. Or when it gets really bad and you need something a little stronger, an antidote that works a little bit better, you can do a body scan. So you sit comfortably, breathe normally, bring your attention to your body. And as you scan your body, you pay attention to different sensations. There may be warmth, or there may be coolness. There could be pressure where your body contacts the cushion or the chair or the floor. You may feel the fabric of your clothes on your skin. Perhaps there's a tingle or a pain point. So start the body scan at the top of your head. Feel the hair on your scalp. Scan your awareness down your face. Relax your jaw. Around your neck, across your shoulders. Relax your shoulders. Scan down your chest and your stomach. Relax your stomach. Scan down one arm and then the other. Go back up to your shoulders, scan down your back. Maybe feel the pressure on your sit bones. Scan down your right leg and foot. Come back up to your waist and go down your left leg and foot. So a body scan can be as slow or as quick as you need. You can spend 2 quick minutes simply focusing on relaxing your jaw, your shoulders, and your belly, 3 places we hold a lot of tension. Or you could spend 20 minutes on a thorough scan of every surface and tension point in your body. These exercises are very simple, and they're going to break the emotions hold on your psyche. That's what we're trying to do. You have a feeling in the moment about what markets and economies might do. You have this fear or greed. You have this envy or this desire, and you're using these exercises to break the emotions hold on your psyche and return you to the experience of the present moment. So becoming embodied in the present moment is a powerful antidote to whatever stories are running through your head. If the narrative resurfaces, as is, changes slightly or intensifies, repeat the mindfulness exercise again, remembering this is a no prediction zone. Remembering our 3 core practices work over long periods of time. Remember that the desire to act or react is normal. And remember always, always, always that the less reactive you are, the better your investments will do long term. These practices can be applied effectively in the moment. However, to really experience the power of mindfulness on your investing outcomes, try to initiate a daily 10-minute mindful breathing exercise. If you do, you're going to see the benefits of the practice more clearly. With practice, you will slowly discover the fear and envy. These narratives have a harder time grabbing you. When they do grab you, you become quickly aware of them as they take hold, and it becomes easier for you to release them and come back to the present moment awareness. As you come back over and over again to the present moment, you will stop being pulled by predictions. Your emotions won't move you to action in the same way, and you will remember the 3 core practices of simple, basic, mindful investing: asset allocation, diversification, and rebalancing. The original promise of better investing outcomes and a better investment experience will be yours. As always, thanks for listening. We've almost completed the entire cycle of the modular financial planning process. Next time, I look forward to describing the final step in our 10-part series, the portfolio optimizers. Simple, basic mindful investing is going to get you 98% of the way there. The last 2% can be managed by considering a few very small things that add a little bit of additional value over time. Things like, maintaining your expenses as low as possible, managing your taxes, and considering the factors of investing. So stay tuned next time to hear the final step in our modular financial planning process, portfolio optimizers. Thanks.
Thanks for listening. Full show notes for each episode, which includes a summary, key takeaways, quotes, and any resources mentioned, are available at mindful.money. Be sure to follow and subscribe wherever you listen to your favorite podcasts. And if you're enjoying the content and getting value from these episodes, please leave us a rating and review at ratethispodcast.com/mindfulmoney. We'll be sure to read those out on future episodes.